Uncertainty over the timing of a rate increase triggering volatility in the markets. Is the U.S. economy too fragile for the Federal Reserve to raise interest rates? We want to bring in Todd Horwitz from BubbaTrading.com and Jeffrey Cleveland from Payden and Rygel. Good to see you guys. Thanks so much for joining us. Jeffrey, you think the economy is just fine, right?
I think the economy is fine, Maria, but I forgot my guitar off set. So
you better go get it.
If I'm break into song, I have to go get it. Third quarter was weak. I think the third quarter GDP number, which we're going to get next week on the 29th, could be a weak number. That could send jitters through the market.
So what's so fine about the economy then? You're talking about weakness.
Services sector looks good. If you separate the economy into these sort of two tiers, you look at the durable side, we do see weakness due to exports. We do see weakness due to the stronger dollar, no doubt there. But services at a 10-year high. And I think that's going to continue to power employment.
Auto sales are 18 million seasonally adjusted.
Absolutely.
There's a lot of
housing did well yesterday, Joe. Yeah.
Where's
He's not buying it.
Where's the housing doing well at? Who's buying the house?
Housing starts. We're up yesterday. They're better than expected yesterday.
But who's buying? The average guy.
Millennials are buying.
But the average guy can't borrow money.
But the problem, it's a very hard thing to diagnose right now because there's traditional historical measures. The economy looks okay, but you and I were talking in the green room where the middle class and the lower middle class, it really doesn't look okay.
Haven't seen their wages move in a long time.
9% drop in real disposable income. Larry Summers said last night the average American has 9 cents less in their pocket per dollar.
9 cents less?
How about they're paying more?
9 cents less per dollar.
How does he get to that? 9 cents less.
He's wicked smart.
I don't know where that number comes from. Where do you get this
calculator
number?
like the rest of the people?
Okay.
Disposable income.
Right.
But my question is, we don't have the demand for big growth. We don't have enough wealthy individuals or governmental demand to push the GDP number north of 2.5%. Am I wrong about that?
I think we're in a 2.5% economy. I think you're right.
But that puts us in a statistical recession.
It's not about being satisfied. The question is, if you have about 2.5% growth, if you have the unemployment rate at 5.1%, if you have the real unemployment rate, right, which
at 10.1%,
at 10.1% and down from 18, so it's fallen dramatically and moving lower. The real question is, should you still be at zero on the federal funds rate?
Well, we're
not in an emergency situation anymore.
Precisely.
I mean, right?
I agree. We're not in an emergency situation. We're in a crisis. I mean, people aren't making enough money. People can't live anymore. The middle class is dying in this country because we have people that say everything's okay and it's not a problem. That is a problem because the average guy is not making any money. You get a job for $12 an hour, $8 an hour when you were making $60. You lose jobs at Schlumberger and you get a job at Walmart. It's a great trade. I mean, that's the kind of thing I'm thinking.
Well, actually, you get a job at Walmart and McDonald's, and then they count it as two jobs for the labor.
So where are you going with this? I mean, where should you be right now? Are you saying just run for the exit?
I think that the first thing is that the Fed should stop day trading the stock market. I think that they need to raise rates under any circumstances. Let the weak flush. It's time,
So even if it causes a great sell-off in the U.S. stock market,
who cares about the stock market? Let's worry about the American people and not about the stock market. 90% aren't even in the market.
I don't think we had the same coffee this morning.
Well, he definitely had his Wheaties. I'll tell you that.
I think the Fed cares less about the market than the market cares about the Fed. If you talk to guys like Bill Dudley, Larry Summers, somebody like Chairman Ben Bernanke, they're more concerned about housing starts. They're more concerned about jobs data. They're more concerned about net consumption growth. I think they're less concerned about the market.
What is it? Larry Summers advised the Federal Reserve not to raise interest rates. He basically said, look, the economy is not strong enough right now.
But also there's nothing going on the fiscal side, Maria.
Right.
Okay, we have a totally dysfunctional Congress and an executive branch. They're not doing anything to help the Fed. There's no extra pillar to support growth in the economy. That's why he's at zero.
Can we go back and talk about the income? I mean, good news on income is it tends to happen later in the cycle when you get less slack in the labor markets. And we have the unemployment rate at 5.1%. We have the real unemployment at 10%. Wage growth should start to pick
Where
up.
do you see wage growth? I would like to know where you see it coming from.
You know what? If you look, it's in the data, actually. If you look at the Atlanta Fed's tracker of wages, which tries to track a median wage earner. So it tracks a certain person through time, which is different than the BLS, which just takes the average wage. It's up 3% in the last 12 months. Now, I would love to see
3%,
4% or 5%, but it's not this anemic, 2% or no wage growth. We are seeing a bit of wage growth. And in real terms, when you factor out inflation.
It's not showing up in the economy, though.
We're seeing 3% growth in consumer spending in Q3.
So what do you recommend? What do you recommend clients with that notion? What's the sort of actionable call?
This feels a little like 2011, Maria. In a way, like when people were really worried that we're on the cusp of a more material slowdown, a recession. Remember, that was the double dip recession talk. So I can't really get into that camp yet. So it doesn't make me too concerned about the equity market. We're a bond firm, so we still see value there. One of the areas that's been beat up lately, your high yield, your investment grade corporate bond sector. We still think there's some opportunity there. So too much pessimism, I think, has been built in here. And we may be due for a swing in the other direction.
Hard to argue with that, with some improvement in the
But I still think Todd's putting his money to work somewhere. Where is that? I mean, you have to do something.
Me personally, I'm putting my money into soft good commodities. I'm buying into the beaten down sectors that I think that are going to have value when we come back. I think that overall, look at Walmart down 40%, Caterpillar down 40%, IBM might as well just go out of business all of a sudden. They've gone from the big blue great machine to they're lucky if they can ever make numbers again. I want to know where the real growth we're going to see without mergers and acquisitions, without the cheap money. Where are we going to really see growth? You mentioned cars. I'm sure you're selling a lot of cars because they're offering this ridiculous 0% financing, which effectively works out to 8% to the public. So they're happy to make those deals all day long. I'd like to get it 0 and sell at 8. But when you look at the overall picture, I'd like to see where are we going to get it? Where's the growth going to come? We keep hearing no inflation, but when I go to the grocery store, when I go to the gas station, I forgot it's X food and energy. We don't count that in our thing.
Yeah, stripping it out. Good insights, guys. Thank you so much, Todd Horwitz, Jeffrey Cleveland. Good to see you, sir.
Nice to see you.
Thank you so much. Despite